Estate Finance and Investments, Risks and Opportunities, 5th edition, authored by Peter Linneman, Ph.D., and Bruce Kirsch. All contents, copyright Dr. Peter Linneman, 2018. Preface. This textbook explores the key concepts of real estate finance and investment strategy. It is not a formulaic analysis of numbers that yield the answer to any and all real estate investment decisions. Instead, this book is designed to help you understand that there is no singular or simplistic answer to any real estate finance problem. Rather, real estate finance is fundamentally driven by judgment and experience with an eye to the numbers. The goal of this book is to help you embark upon the long and unending road of building your judgment. The chapters in the text assume that you have a mastery of the foundational material in the prerequisite chapters, including loan amortization, discounted cash flows, net present value, and IRR. Before you start, be absolutely certain that you are comfortable with these materials in the prerequisite chapters. The supplemental chapters provide interesting information, but are not essential for you to master the chapters in the text. The formulas and templates found in the chapters and in the online companion will help you assemble and organize information. However, mastering these tools is merely the beginning, not the end, of real estate finance. This book focuses on what to do after you have mastered the basic financial tools. Just as knowing how to use a hammer and saw is not the same as building a wonderful building that will last the ages, knowing how to build a financial model and calculating the IRR is not the same as making a profitable real estate investment. And no one would ever fly in a plane which has only been modeled. Judgment comes one mistake at a time, and better to make some of those mistakes in the classroom than in real life. Please note that throughout the text, for the purpose of conveying concepts in a more digestible manner, we assume that loans and loan debt service reflect interest-only loans, unless otherwise specified. Additionally, please take note of the online companion icons in each chapter, as they provide you with valuable hands-on exercises and point you to additional audio content that will enrich your learning experience. We hope you enjoy the book. Chapter 1. Introduction, Risks and Opportunities. Saying no is as important as saying yes, only tougher. Dr. Peter Linneman. Risk and opportunity. That's what it's all about. Real estate investment is all about risk and opportunity. There is never an opportunity without risks, and the greater the perceived risks, the larger the perceived opportunity must be to justify investment. The value of a property reflects the assessments of the associated risks and opportunities. What is the property worth if everything goes according to plan? More importantly, what can go wrong? What do you do when it does? And how does that impact the property value? Identifying the relevant risks and answering such questions dominates the analysis of both equity investors and lenders. While spreadsheets and math will be required, these tools cannot make judgments about risks and opportunities any more than a hammer or saw can decide what type of building to build. There are many wrong answers, but there is no single right answer, as different investors and lenders have different operating skills and risk profiles. Sadly, the right decision is never 100% clear at the time a decision must be made. So if you're looking for the right decision, look elsewhere. It is critical to understand that equity owners, once they have fulfilled their financial obligations to their lenders, receive the upside or financial reward of their investment. Lenders, on the other hand, have a contractual ceiling on the return they can receive from lending on a property, namely interest and timely return of principal, though the return from interest can be large. In this chapter, we draw the distinction between equity investing and lending, or debt, to clarify that both sides are critical to real estate investing. Throughout this textbook, we look primarily through the lens of equity investors. Nonetheless, in many cases, when we use the terms investor and investment, they can potentially apply to both equity investors and lenders. Suppose you are faced with the opportunity to be a financial stakeholder in the acquisition of an office building, Felicitas Tower, leased to the U.S. government for 10 years. Based on your analysis, you estimate that net cash flow will be about $3 million each year of the lease. How do you assess what the property is worth? If you have a financial background, you will immediately turn to discounted cash flow analysis, DCF. You select a residual capitalization rate to determine a potential terminal or sale value in year 10 based on expected cash flow. Then you select a discount rate with which you discount each year's expected net cash flow, including the terminal value, to the present. That present value is the estimated value of the property today. Given that this is a 10-year lease to the U.S. government, the risk-free 10-year Treasury rate might seem like an appropriate discount rate. But how does the risk of investing in this building differ from that of a 10-year Treasury bond? Would you rather own the Treasury note or Felicitas Tower, assuming your annual cash flow projections for both investments were the same? Will your cash flow estimates prove to be accurate? What happens when the current lease expires in 10 years? And what discount rate should you use? Always use a risk and opportunity framework relative to other investments in addressing such questions. Potential upside needs to compensate for the reality of risks. What risks and opportunities are unique to Felicitas Tower versus your investment alternatives? If you become a financial stakeholder in this tower, are you emotionally and operationally situated to deal with unexpected challenges? The risks. Unexpected and even unimaginable outcomes can and will occur while a financial stakeholder in real estate. Planes crash into the mall courtyard 2 days before Christmas. Seemingly great credit tenants like Lehman Brothers, Arthur Andersen, and Enron disintegrate overnight. Energy prices double in a year, and sometimes these all happen at once. Operating expenses. You could experience an unexpected increase in operating costs, which would decrease the building's net cash flows below your expectations. Utilities, property taxes, maintenance salaries, insurance, and numerous other costs are likely to fluctuate throughout the life of the lease. Although specific contractual lease terms may alleviate some of this risk, you may be unable to pass all operating cost risk to the tenant. No matter how carefully you analyze these costs, I promise you that your forecast will be wrong. But wrong does not necessarily render your analysis meaningless. It just means that you must understand the actual outcomes are not as certain as they appear to be on your beautiful and beloved spreadsheet. Vacancy. As a financial stakeholder, your cash flows are directly dependent on the U.S. government performing on the lease, that is, making their rent payments in full and on time. There may be intricate wording in the lease, a thick and detailed document, which provides the government with relief from its lease obligation under certain obscure circumstances. If the government is the sole tenant and ceases to pay rent, you will receive no income as an equity investor. If you are the lender, you will receive no debt service payment for weeks, months, and perhaps even years. How fast can brokers release the space if the government is able to get out of the lease and decides to leave? Will ownership be able to obtain equal or better terms from a new tenant? Will the new tenant require the landlord to remodel or reconfigure the space? Natural disaster. Although it may seem remote, there is a chance that a natural disaster may substantially damage the building. In such a case, depending on the lease, you could face significantly reduced income streams or no income at all. In addition, ownership will have to spend time and money to renovate the property. For this reason, it is particularly important to know whether the space is, for example, in a hurricane-prone area or a flood zone. Since property and casualty insurance can reduce the impacts of disasters, you must also evaluate the property's insurance coverage. In some events, insurance may be cost prohibitive. Leasing. What happens at the end of 10 years? If you hold a U.S. Treasury note, you get your money back with certainty. With building ownership, you must either extend the government's lease or find another tenant. If the government does not renew, ownership receives no income until they successfully release the building, and the lender will simultaneously suffer the consequences of no debt service payments. Liquidity. Liquidity refers to the ease with which one can convert an asset to cash. The building is far less liquid than a government bond. You can sell Treasury bonds in minutes for a small fee, while selling the building may cost you 3% in fees and take 6 to 8 months. What if you need capital in a hurry? How quickly do you think you could sell the building? What will the real estate market look like when you're ready to sell? All too often, when you are under pressure to sell, it is because there's a shortage of interested capital. Thus, you run the risk that your attempt to sell will occur in a distressed market. This is far from a complete listing of the risks associated with investing in a building either with equity or debt. Yet you can see that the risk is greater for owning the property than for a 10-year U.S. Treasury note. Consequently, the potential reward must be commensurate with this higher risk. The opportunities. While there is no cash flow upside in holding a U.S. Treasury note for 10 years, there may be opportunities to enhance the cash flow from the building, further protecting the lender's debt service and further rewarding ownership. Operating expenses. Ownership may be able to leverage and exploit their management expertise to lower the cost of operating the property, thereby increasing cash flows. There may also be potential operating cost synergies between this property and other real estate owned by the equity holders. Terminal value. The value of the building at the end of the lease may appreciate as a result of economic growth or general inflation, allowing you to sell the property for a considerable profit. Alternatively, you may be able to release the property to the government or another tenant for more favorable terms at the end of the initial lease. Rental growth. The lease may provide mechanisms to increase total rental payments over the term of occupancy. Instead of $3 million per year for 10 years, the lease may call for 3% annual rental rate increases. Such contractual cash flow increases need to be factored into your analysis. Although there are many additional opportunities for increasing the realized return, you can see that the opportunity is greater for owning Felicitas Tower than holding a U.S. Treasury note for 10 years. Since the property has both greater potential upside and downside than the 10-year Treasury note, you need to adjust the discount rate accordingly. Conceptually, the right discount rate to use is always the rate which is reflective of the risk of the anticipated cash flows. How many basis points you must add to the 10-year Treasury rate is based upon your assessment of the likelihood of the property's risks. But there is no magical website or formula that will tell you the right discount rate for an office property leased to the U.S. government for 10 years. If, as the equity owner, you think the risks are minimal, and you are certain you will never sell the building, then you do not require a much higher discount rate than the Treasury rate to offset the added risks of owning the building. By using a low discount rate, you will impute a higher value and submit a higher bid, increasing your opportunity to acquire the property. Of course, you also increase the risk of overpaying for the building if unexpected negative events occur. Are you right for using the lower discount rate and offering a higher bid? Only time will tell. On the other hand, you may demand significant compensation for the additional risks of the property. In this case, you will use a notably higher discount rate and offer a lower price for the building, running the risk of losing the building to a competing bidder. Is this the wise move? Again, only time will provide the answer. Figure 1.1 displays how various discount rates drastically alter the value of an existing commercial property with an assumed 6% annual income growth rate. There is more than a 40% difference between the sum of the property's nominal expected total cash flows and the property's present value when cash flows are discounted at 12% annually. The former case reflects a perception of zero risk, that is, a 0% discount rate, while the latter reflects perception of significant risk. Going back to the Felicitas Tower investment opportunity, how would your analysis change if the tenant was a startup company instead of the U.S. government, even if all of the financial terms of the lease were the same? What additional risk and opportunities are associated with this tenancy? You need to assess tenant credit risk. Will the tenant pay on time? Will the tenant default on the lease? If so, will you be able to release the property for similar terms? How long will it take you to release the space? What costs do you incur when releasing the space? You must measure the discount rate based on your assessment of these additional risks, as the U.S. government is clearly a better credit tenant. How many basis points should you add? Only you can decide. As you gain experience and expertise, you will become better at assessing these risks and opportunities. As this occurs, you will become more accurate in your assessment of value. Where you should focus your analysis. Now that you know how to think about selecting a discount rate and realize that there is no magical valuation website, what should you spend time trying to calculate? The future cash flows or the discount rate you apply to those cash flows? The answer is, of course, both. But at the margin, focus on understanding the expected future cash flows. You need to know what can happen at the property and understand how the property generates its cash streams. Carefully exploring future cash flows is nothing more than trying to understand the business and its risks. Therefore, choose your discount rate wisely, but do not obsess over its selection. Understanding expected future cash flows gives you insight into why you may fail to meet your projections. This will make you focus on what you will do if the property cash flows do not meet your expectations. You should focus primarily on the downside, because if the property does better than expected, trust me, you will be able to cope with it. Even more important than your cash flow projections, and certainly more important than the discount rate selection, is understanding why things may fail to go according to plan, and what will happen when this occurs. This, and being able to say no, is what makes a great real estate investor. Market research. One of the most important elements of underwriting the purchase, sale, or development of a property is to carefully analyze the market's supply and demand balance. These supply and demand conditions provide the backbone for assumptions about future rents, cost recoveries, marketing costs, the time required to lease vacant space, the vacancy rate, operating costs, and ancillary income opportunities. Focusing first on supply, it is essential that you conduct a detailed evaluation of properties in the marketplace. What are their strengths and weaknesses? How are they priced? Are they experiencing increasing vacancy? Are their tenants satisfied? Why? Are major leases about to expire at these properties? Have new tenants entered the market? Which tenants have become too large or too small for their current space? What ancillary income are owners achieving? What design features and amenity packages at these premises do tenants value the most and the least? What marketing techniques are attracting customers? What leasing commissions are they paying brokers? What are their typical tenant improvement and concession packages? Can these properties be easily expanded or modified to meet additional demand? In addition, you must carefully check what new properties and property expansions are underway, as well as what building permits have been granted and are soon to be granted. Talk to local brokers and bankers to assess who has tentative plans for new properties in the market. Are major competitive property renovations or repositioning projects anticipated? Which of these projects are most likely to come to fruition, and which are probably pipe dreams? While doing this homework, never forget that talk is cheap, but bricks and mortar are very expensive. When investigating a property site, aerial photography can help identify other sites which are available for competitive product, as well as provide a perspective on local land use patterns. For larger projects, you may want to tour the area by helicopter to better understand traffic flows and development patterns. Study the past 30 to 40 years of local development to see in what directions development is going and at what speed. You need to understand the local zoning ordinances and politics to assess whether new product is easily brought online, and if so, potentially where and by whom. Carefully assess planned traffic and infrastructure improvements, as well as where the utility backbone extends. Assess whether state or local tax incentives are available to you, your competitors, or key tenants. Turning to market demand, Do you have a major tenant in your pocket that can fill vacant space? Has a major competitor of your tenant, such as Walmart, recently moved into the area? If not, can they easily do so? Where and when? What adjustments can you make at reasonable cost to the property to attract tenants? What design and amenities can you use to more effectively market your property? How do the location, signage, and ingress and egress aspects of your property compare with others? How do the operating costs, design, and technological capacities of your property compare to competitive properties? Can you increase rents and remain competitively priced? In addition, you should study the fundamentals of local, regional, and national growth. To this end, you can utilize research publications such as the Linneman letter and Rosen Consulting Group analyses to evaluate if and why the area will grow, and how it is affected by national and international economic forces. Taken together, these analyses will enable you to better assess the risks to the property. Who are the major local employers? Are they growing? What major challenges do they face in their businesses? What type of space do these tenants use? Ask brokers about unhappy tenants looking to relocate. Can their business support the increases in rental costs you project and remain competitive in their industry? Always extensively drive and walk your market. Understand who lives in the area and whether the market is moving up, down, or sideways. The cars in the neighborhood generally provide an excellent predictor of the resident's economic status. In addition, you may purchase a more detailed local market study, but be wary of people selling the next big thing, as supply frequently has been put in place over the years in anticipation of next big things that never happened. Evaluate why projects have failed in your market, as well as why they have succeeded. Ask yourself whether you can provide tenants something better, cheaper, or faster than your competition. If you can, your property will probably succeed over the long term. Read all available market reports and analysis of competitors. The advent of publicly traded real estate firms has greatly increased the quality and quantity of such information, as some of your competitors may be public companies. Just remember that such information is often conflicting or merely promoting faddish ideas, such as the dot-com mania in the late 1990s, and is never a substitute for informed judgment. The best way to understand a particular market is to devote your career to a specific product type and geography. Your goal is to get to the point where literally nothing happens in your market without your knowing about it well before it occurs. Obtaining market knowledge is not glamorous, but it pays handsome returns for the diligent. Remember that there is no shortcut to understanding a market. Becoming a real estate professional entails building a knowledge base and acquiring the expertise to answer the many questions we have raised, rather than just assuming answers. I am frequently asked, "Is it all right to assume?" I invariably respond by saying, "You can assume whatever you want, but you will ultimately be judged on the accuracy and defensibility of your assumptions." Personal decision. Your investment decision ultimately depends on who you are, how much risk you are willing and able to take, what expertise and cost synergies you bring to the deal, and your investment goals and experiences. Figures 1.8 through 1.11 provide examples of how personal choices and perspectives can drive real estate investment decisions. Each graph displays the probability distributions of expected returns for 4 distinct real estate investments. Each of these hypothetical opportunities has, in retrospect after exiting the investment, an expected IRR, or average annual return to equity, of 15%. That is, the pro forma, or projected numbers for each of these investments are the same, namely a 15% average annual return. However, the investments are vastly different in terms of the likelihood of the projected numbers occurring. Consider the unique risk and return profiles of these 4 investment opportunities reflected in the different probability distributions of their respective returns. Depending on your expertise, balance sheet, risk preference, experience, and deal flow, these 15% return deals may or may not appeal to you. Opportunity 1, shown in Figure 1.7, is the acquisition of Henderson Office Park, a fully leased property with a large number of high-quality tenants and lease expirations occurring smoothly over a 20-year horizon. This investment offers a 15% expected average annual return, with a relatively symmetric chance that the property will perform above and below expectations. The vast majority of the expected return outcomes for investment in this property are very close to the expected return. Finally, this investment opportunity offers relatively little chance of losing invested capital. Opportunity 2, shown in Figure 1.8, is the acquisition of Jessica Distribution Center, a built-to-suit logistics property 100% occupied by a single tenant with a long-term lease. The tenant has low credit quality but is growing fast. The investment opportunity, which also has an expected 15% average annual return, offers 3 potential return outcomes. In Scenario 1, the tenant goes out of business and no one else wants to lease the space. In Scenario 2, the tenant goes out of business and you re-lease the space, though at less favorable terms. In Scenario 3, the tenant prospers and renews their lease, allowing you to avoid additional lease-up costs. While the overall expected return is 15%, the return distribution offers a substantial chance that you will lose money. However, Opportunity 2 offers greater potential upside than Opportunity 1, with about a 1/3 chance of returning greater than 30%. In contrast, Opportunity 1 has a significantly lower chance of generating a return in excess of 30%. Opportunity 3, shown in Figure 1.9, is the ground-up development of Selena Gardens Apartments, also offering an expected 15% average annual return. The property is in a frontier location with relatively little operating history for your product. Since there is little information that you can use to determine the expected returns, the project seems to offer a relatively uniform opportunity of success and failure. In this case, the opportunity offers greater chances of both substantial success and failure than either Opportunity 1 or 2, with less chance for mediocre performance. Opportunity 4, shown in Figure 1.10, is the ground-up development of Leslie Center, a complicated and expensive major mixed-use project that you hope will revolutionize the market. The opportunity, which also has an expected average annual return of 15%, presents 2 very distinct outcomes. Under Scenario 1, the market essentially rejects a product and you may lose a lot of money. While under Scenario 2, the market loves a product and it is a huge success. If it succeeds, Leslie Center makes significantly more money than the other properties. Which one of these pro forma 15% return investments is best for you? Note that these investments look the same based on pro forma IRRs, but offer radically different real estate and investment propositions. Which, if any of these investments you make, depends on who you are, your investment goals, and your operating expertise. What is right for you will often be wrong for another investor. Never think that the numbers can make investment decisions for you. A mastery of the numbers is important, but merely the starting point for investment analysis. You must learn how to do the numbers, but understand that it is just barely the beginning. Risk parameterization. What differentiates these 4 investment return distributions is not the average annual expected return, but their risk profiles around the expected return. Normally, financial economists frame investment risk through statistical analysis methods. Specifically, they look at the standard deviation of the asset's return, as well as the covariance between returns for the asset and returns of a broader set of investable instruments. While these concepts are appropriate, they are of little assistance to you in evaluating any specific real estate investment. Why? First, summarizing an investment's risk by its standard deviation and covariance of expected returns assumes that the returns have a Gaussian normal distribution. However, as is obvious in our 4 examples, most real estate deals do not have normal return distributions, and therefore the standard deviations and covariances are not sufficient to fully summarize the investment risks. This problem is exacerbated for properties with return distributions that are non-continuous, asymmetric, and highly skewed. An additional difficulty of utilizing the standard deviation and covariance of returns to summarize risk is that it is almost always impossible to calculate these statistics for most real estate investments. Unlike stocks and bonds, a typical real estate investment lacks the return history with which to parameterize or estimate either the standard deviation or the covariance. The problem in this case is not a conceptual one, but a practical one. A further challenge is that the expected return, the distribution of positive returns, and the covariance of returns with other assets can change quickly and dramatically. For example, in the early 1990s and 2007 to 2009, the expected returns for all assets plummeted at the same time due to soaring risk premiums relative to government bonds. As a result, even assets with historically low covariance suddenly experienced near-perfect covariance with the market. Assets experience plunging expected returns and much larger left-side tails, that is, downside risk, in terms of return outcomes. In short, risk is not a fixed concept, but rather an ever-changing reality. As a result, while the notions of standard deviation and covariance as measures of risk are useful intuitions to bear in mind, as a real estate investor, you must rely on less statistically based analyses of risk. This includes addressing questions to determine what makes a property succeed or fail. Can it weather a downturn in the economy? What if a tenant leaves? What happens if interest rates rise? This is how you attempt to measure the risk of the investment. Never forget that your brain is an extraordinarily sophisticated computer as well as a great synthesizer of information. As your experience and knowledge grow, this truly portable computer becomes increasingly sophisticated in calculating risk. Bearing this in mind, real estate returns tend to have a comparatively low correlation with stocks and bonds because real estate's relatively fixed income streams are driven by contractual lease obligations. As a result, when the economy does well, real estate responds with a lag as leases expire and renew based on their specific calendars. The converse is also true. Similarly, real estate is a partially fixed income investment and, like a bond, is somewhat sensitive to interest rates. However, unlike most bonds, the cash streams and residual values of real estate tend to rise with inflation. Therefore, real estate tends to have a low correlation with bonds. But never forget that when capital seeks extreme safety, all asset classes become very highly correlated. It is also important to remember that if you're in the real estate business, you are in the business of taking risks. It is your expertise and core competency. As such, you may want diversification, but that is a luxury afforded primarily to passive investors. As a real estate professional, your business is to exploit your expertise, even though it may not keep you as diversified as you would like. For example, if you have $2 million in available capital, and the typical project in which you specialize requires $2 million to execute, you will not have enough money to both execute the project and diversify your portfolio. Does this fly in the face of portfolio theory? As an investment matter, yes, but it is consistent with the exploitation of your competitive advantage. That is, exploit your core competency, and in doing so, maximize your profits. There is generally a conflict between the desire to diversify your portfolio and exploiting your expertise. You cannot do all the deals you evaluate, even if they are attractive on a risk-return basis. You do not have enough capital, labor, or resources available. Therefore, you strive to determine which deals deserve a no, not only because they may have negative net present values, but also because they do not most effectively utilize your skills and meet your investment objectives. The spectrum of real estate investment profiles, examples of transactions, general targeted returns, and leverage levels employed are displayed in Figure 1.11. Closing thought. Becoming a successful real estate investor comes very slowly. It is a process of making decisions, dealing with the consequences, and hopefully learning from the experience. If you go into business as a real estate entrepreneur, you will start your career making relatively small investments because the capital available to you will be limited due to your lack of sophistication and experience. As you develop your expertise, become more sophisticated and better at managing risks, and learn how to generate returns even when things go wrong, you will find that you will attract a larger investor base and have the ability to take on larger and more sophisticated deals. Real estate investing is a career rather than a one-time event, a marathon, not a sprint. Thus, if you want to be a successful real estate professional, patience and learning when to say no will be your greatest allies. To hear a conversation about this chapter's content, go to the online companion and select the link for Chapter 1. Scroll down to the audio interview section and listen. This has been an excerpt of the 5th edition of Real Estate Finance and Investments, Risks and Opportunities by Peter Linneman, Ph.D., and Bruce Kirsch. All contents copyright 2018 by Dr. Peter Linneman. To purchase the textbook, go to linnemansssociates.com. That's LINNEMAN Associates.com.